And so my fear is that as we see the economy slow down due to higher interest rates, and we now have the Fed funds rate around 5%, you're going to start to see a recession kicking in probably in the second half of this year. And the kicker is going to be that inflation is unlikely to get back below 2%. It might get close. It may be 3%, 2.5%. But if the Fed won't come out and print right away, how does the market, how does the economy find its way out of a recession? It doesn't know how to anymore. In fact, you could argue that the Fed has broken the underlying ability for the economy to get out of a recession. So I think that's where I'm looking at it from that kind of vantage point. And I do think that that's the likely scenario here. We're facing, it's not going to be like a depression. I don't foresee that in the next couple of years. It's more like going to be a tough economy that's going to last for years.
In today's video, our guest is Gareth Soloway, well known for his expertise in analyzing macroeconomic trends, utilizing technical chart analysis, and providing trade signal alerts. Master trader Gareth Soloway will cover macro analysis, technical charts, and trade setups for the day in stocks, commodities, and crypto. Before proceeding further in this video, please make sure to click on the subscribe button below to stay updated with our latest content. Soloway acknowledged that Bitcoin has seen a significant increase of over 40% in value since the beginning of 2023. A key indicator of profitability in the Bitcoin market just turned negative, a bearish sign according to some analysts. Despite the recent positive movement, Soloway firmly asserts that Bitcoin remains in a general downward trend. According to Gareth, Bitcoin enthusiasts may need to moderate their optimism regarding the short-term outlook of the digital currency. Soloway does not expect similar performance from Bitcoin and suggests Bitcoin could drop to $18,000 per coin.
But I do think, for instance, Bitcoin longer term, very, very bullish still. Now, in the near term, though, it's important to recognize that I still see further downside. So I've been a bear since 69,000. There's bounces along the way. We've seen one of the great bear market rallies here. But what we can see here is you almost have that same M top that formed when we were at the all-time highs. Like if we go back to this chart, look at that same sort of chart pattern, which is exactly what we just created on a very smaller scale. So the question now is, we had a bear flag here, it broke down, and now we're making another bear flag, and my guess is we are headed back to 18,000 and change probably in the next month or so. So I do think you have downside on it. I still have a lower target. I still don't think Bitcoin has fully bottomed out in this cycle, and I still think that, again, too many people are bullish on Bitcoin and crypto. Like as soon as it pops, 1 million people come out on Twitter all like, this is the new bull cycle.
When asked about gold's downside and upside potential in 2023, Soloway said $1,600 per ounce is the lowest he would expect to see. However, the yellow metal could take off if it can make it past resistance at $2,050 to $2,070. Gold futures in the U.S. saw a 0.3% increase, reaching a value of $1,859.90. Interest rate hikes to contain high inflation discourage investors from placing money in non-yielding assets such as gold. Gareth believes that currently gold is in a wait-and-see mode. Mostly quoted in U.S. dollars, gold price tends to increase as stocks and bonds decline. If gold prices convincingly break below the latter, it will serve as a new signal for bearish traders and increase the likelihood of further downward movement, leaving gold prices susceptible to further declines.
So we know that gold was the best performer between the S&P 500 and Bitcoin in 2022. And right now it's having a very solid year. It's not outpacing the S&P or Bitcoin yet, but my guess is it ultimately will by year end. And what we can see here is you had this beautiful rally up. You broke out above this area here on the gold daily chart. You continued up, and then we pulled back. And notice where the pullback took us. It took us right to the previous pivot point. And that's a picture-perfect chart setup, right? So basically, this was where I was looking to accumulate gold again, and that's exactly what I did. Now, again, what we've seen is a 4 or 5 day move up. Now you're getting a pause day. But looking at the bigger picture, for me, when I look at this bigger move, I am expecting gold to retrace to the all-time highs around 2070. And actually, by year end, I'd be somewhat surprised if we're not through that level. So I do see upside here. Absolutely. I continue to be a big bull on gold, mainly because it offers protection in an uncertain economy, but it also offers an inflation hedge, right? So if the economy spins into recession and inflation comes down, you also have the positives of gold. Or if inflation stays high and the economy still ramps up, you still have that side of gold as well. So it's kind of like a good side on either in either case of the economic situation. It definitely not necessarily just pure upside, but in the very least, this 1800 level is major support. And we saw the bounce so far. So what I'm going to be looking for is you have a little bit of a trend line here, right? So we can connect these two previous pivot highs. It's around 1940 on gold. Can we go up and test that? If we do we break through? If you break through the low end of the 1800 level, it's going to bring you down to this area down here. Let me put a trend line in there so we can keep our bearings. All right. So for me, at least based on what I'm seeing, I actually think that this was a bigger breakout on gold that we're just seeing a natural retrace on. So we should ultimately continue higher. But in the off chance that I'm wrong and you do break 1800, you have more major support at 1725. Basically, zero interest rates to about 5% on the 10-year, or excuse me, 4% on the 10-year, but Fed funds, again, pushing north of that level, obviously. So what we've seen is gold has held up amazingly well in spite of high interest rates. And if interest rates are getting near a peak, then you actually should see gold actually perform very, very well. And assuming at some point, like I do, that even if it takes 6 to 12 months for them to lower rates a little bit, that's going to kick in even more interest in gold. And I think there's this feeling now where, people are a little bit more shaky on crypto. We don't know the regulations. We know Silvergate recently, FTX, like these other things where you had Bitcoin as an obvious alternative to gold. It's not so obvious right now. And it's pushing a lot of money towards the gold market as well, as again, people are saying, hey, listen, what's the good trusty safety hedge here? And that remains gold. So I really do think that's the key. A down dollar would be good for gold. Interest rates topping out would be good for gold, even if they don't get lowered. All of those things, again, should be a positive for the yellow metal.
Although economists anticipate the Federal Reserve will continue to raise interest rates, many see a peak in the first half of the year. At the same time, fears of a severe recession are raising forecasts that the U.S. Central Bank will start to ease rates by the end of 2023 or early 2024. Although inflation has dropped sharply from its 2022 summer highs, it remains persistently high. Rosenberg said that the Federal Reserve's fixation on bringing inflation back down its 2% target means it will be slow to react to growing economic weakness.
I mean, my guess is it's going to be at least 2 to 3 years. And then my guess is the economy will start to get worse and worse, which will then force the hand of the Fed. So even if we're at, let's say, 2.5% inflation, if you all of a sudden see 10% unemployment, the Fed will feel forced to act at that point, and then you'll get some sort of stimulus going again. The only problem is it starts the merry-go-round again, where you have then higher inflation coming in over the next few years. So, I mean, this is one of those things where it's like a drug addict. When you get addicted to it, it's very hard to get off the juice, if you will. And that's what the economy's facing now. So I am in the camp that I do see significant downside from here. I think that investors are there. There's these phases when a bull market ends in the preliminary portions of a bear market where investors get very excited because they remember the good times, right? And the good times were Dogecoin and SHIB going up, hundreds of X times, maybe more. And like, AMC and GameStop and all these other ones, right? So you have these interim periods in markets where people say, oh, well, maybe we're going to get back to that. Let's buy everything that was running during that period. And you'll see those stocks pop. And we have seen that quite a bit. My bigger issue is, even though we've closed above this trend line, right? So this is a trend line that goes all the way from the all-time highs on the S&P, and you have had a bounce off of that. My bigger issue remains that we haven't even retested the pre-COVID highs here. And again, if we look at what's holding this market up, so you have the hope that the Fed pauses, but even if the Fed pauses, they're not going to lower interest rates anytime soon. Powell's made that super clear that he doesn't want to repeat the mistakes of Paul Volcker back in the 80s. So you have long-term interest rates staying probably elevated for a significant amount of time until the economy starts to go into a recession, which is kind of, you could argue that the Fed wants that. I mean, essentially, they've said they want that. So if we go into a recession, you're going to see an earnings recession. And if that happens, then valuations are still way, way too high here. So at some point, I do see another collapse back down. Target for me on the S&P, first target would be this 3380 level. And then eventually, I think you have to go back to this long-term trend line, right? So if we go to the weekly chart, there's this long-term trend line that goes back to the lows in 2009 when we came out of the Great Recession. And that trend line hasn't been tagged in the longest period, right? So if we look at this trend line, there was a little bit of a gap here. This was about 3 years. Then it was about 4 years or so here. and then another kind of dip of about 3 years. And then really just between then and COVID, it was only a year to 2 years. We've now haven't tested this trend line since 2020, right? So we're now getting to the longer end of that. In addition, we were so far above it, it makes me almost feel like we almost need to even go below that. So I won't go to that extent and say, hey, we're definitely going below that long-term trend line. But I think the 3,000 level, it's a round number. It's got to be where we're headed back to.
According to Gareth Soloway, a long-lasting economic recession is likely to occur and interest rates are expected to remain high for an extended period. Soloway believes that the U.S. Federal Reserve will only contemplate lowering interest rates if there is a widespread and severe recession. He also predicts that gold will emerge as one of the best-performing assets this year. That's all about today's analysis. What do you think of Gareth Soloway's predictions for gold and cryptocurrencies in 2023? Do you agree or disagree with his outlook and why? Share your thoughts in the comments section below. If you found this information helpful, please consider giving this video a thumbs up and subscribing to our channel. We look forward to bringing you more updates in the future.